Hello everyone, this is Dr. Tao's Quant Lab. In this video, we move to section 1.2 and address a very simple but important question. Who actually trades the market? Before we talk about price formulation, market makers, or trading strategies, it's important to understand who is placing orders and how different participants interact. Many misconceptions about trading come from misunderstanding this point. Let me start with the big picture. In US equity markets, prices are not preliminary driven by individuals clicking buy and sell on their phones. Most day-to-day trading activity is generated by professional participants operating through large institutions. In addition, most execution today is rules-based and algorithmic, not discretionary. This brings us to a basic distinction. Ins- Institutional investors are organizations that invest capital on behalf of clients or beneficiaries. This includes mutual funds, pension funds, insurance companies, hedge funds, banks, and similar entities. They typically operate under formal mandates, risk controls, and execution constraints. Retail investors, by contrast, are individuals trading their own money for their own accounts. Here's the key intuition I want you to remember. Institutions do not trade like individuals. They care deeply about transaction costs, liquidity, and risk limits. As a result, their trades are usually executed through systematic workflows rather than one-shot decisions. Now, initial question people ask is, how much of the market is retail and how much is institutional? The answer depends on what we mean by participation. One notion is trading volume share. Who is trading at a given moment? This can change quickly and depends on market conditions, definitions, and trading venues. Another notion is equity ownership or holdings. Who ultimately owns equities? That changes much more slowly and reflects long-run capital allocation rather than short-term trading activity. In this note, we focus on trading volume to build intuition about price dynamics. This table summarizes industry-based estimates of the retail share of the US equity trading volume using post-2018 data reported by BlackRock. The numbers are approximate and depend on how retail orders are classified, but the pattern is very clear. Retail participation rose sharply during the extraordinary conditions of 2020 and 2021, driven by pandemic volatility, fiscal stimulus, and the widespread adoption of zero commission trading. As market conditions normalized and monetary policy tightened, retail trading activity declined towards more typical levels. And most recent exchange commentary and industry reports suggest that after the post-2021 cooling, retail trading has broadly settled back into something like the low 20% range. Though there is no single official number and estimates vary by methodology. The important takeaway is structural, not numerical. Retail participation can spike during unusual episodes, but the scale of institutional capital and automation makes it unlikely that very high retail trading shares persist over long horizon. Next, we briefly clarify what we mean by institutions. When people say institutions, they are not referring to a single group. In practice, this includes mutual funds and ETFs, pension funds, insurance companies, banks, and dealers, hedge funds, foreign investors, and certain government-related accounts. These groups differ in objectives and behavior, but they share one important feature. They trade with constraints and typically separate decision-making from execution. That brings us to one simple idea about how institutions trade. Institutions usually separate trading into two layers. First, the decision layer, or to buy or sell, how much and why. Second, execution layer, how to interact with the market while minimizing cost and information leakage. For this course, you only need one practical insight. Execution itself can move prices. Large orders cannot usually be executed instantly without affecting prices. So institutions often trade systematically, splitting orders over time and routing them across venues. As a result, many short-term price movements reflect execution mechanics rather than new fundamental information. This idea becomes even clearer when we talk about program trading. In modern markets, program trading simply means rules-based. Algorithmic order execution, exact percentages vary by definition and venue. But US equity trading is heavily electronic. The key implementation is that short-term price formulation is meaningfully influenced by fast, systematic execution rather than exclusively by new information. Here's the main takeaway for retail traders. Short-term prices fluctuation are formed in an environment dominated by professional, fast, rules-based trading. You should not interpret every intraday move as evidence of smart money, conviction, or hidden fundamentals. This section sets the stage for the next topic. Once we understand who trades the market and how orders are executed, we can introduce market makers and their rules in liquidity provision. This helps clarify why spreads exist and why prices are often shaped by trading mechanics rather than by a single controlling actor. All right, that concludes section 1.2 on who trades the market. In the next section, we will study market makers and the mechanics of price formulation.